For those that aren't familiar, this is Tech Talks. It's kind of the intersection of traditional finance and emerging technologies. Today, I'm real excited because this kind of feels like we're going back to my roots, because this really started as Crypto University and then turned into Tech Talks as we kind of broadened the subject to other kind of emerging technologies as it relates to financial services. Since we are going to be talking about crypto today, I am going to put a short little disclaimer out there, and that is all information that we'll be talking about today, including ideas, opinions, views, predictions, forecasts, commentaries, or suggestions implied or expressed here within are for informational, entertainment, and educational purposes and should not be construed as investment advice. The past results are not indicative of future performance, and don't anyone trade on anything we're saying here today. So I just want to make sure we get that out of the way for any attorneys that might be on the call. With that out of the way, I want to introduce Ken Chapman and Ben Duggan. Both of them kind of OGs in this space. You guys are certainly, as it relates to being in this space, a lot longer than I have been. You guys both have a really great background. Ben with kind of your DeFi stablecoin experience, Ken on the kind of the investment tokenization, and I know you've got kind of a consulting company that's also doing this stuff. Ben, you run a couple companies as well. So I'll let you two do your own introductions. For the folks on the call, I want this to be conversational, so we actually don't have an agenda today. There are a couple of topics we can talk about, but there's a lot going on in the digital asset ecosystem, particularly around institutional adoption, not just of digital assets, but more even the underlying technology and this kind of continued tokenization of money. And so we'll hop into that. Anyone is welcome to jump into the discussion. In fact, we would encourage that. We're really fortunate to have two really bright minds on the call that know this stuff far better than I do, and I'm really excited to talk to both Ken and Ben. With that, Ken, I'll let you do an introduction, and then Ben, you can do an introduction, talk a little bit about who you are, kind of what your current role is, some of your past role, how you got into crypto. You can probably take 10 minutes to talk a little bit about your background, and then we'll talk about kind of current going-ons in the market.
Ben, would you like to go first, or?
Sure, go ahead.
So, my name is Ben Duggan. Had securities licenses for about 15 years now, traditional asset management, up until about 2020. Managed a couple $100 million book, mostly in equities and bonds, and it's also about $1 billion in bank deposits for cash management portions. And then also in about 2021, opened up the US's first DeFi stablecoin fund, traded on 11 different layer ones, layer twos, mostly arbitrage, market neutral trading. And from there, have done consulting for a bunch of different financial institutions. And most recently, co-founded a software startup that was called Arrow and Lockbridge, which deal with cloud-led data transmission for financial institutions. Still in the same crypto ethos of maintaining control of the asset, but right now more on the data side than the asset management side. So my introduction was definitely not 10 minutes. I'm sure no one wants to hear 10 minutes about me. So I'll pass the mic to Ken.
I'm gonna come back to you. I want to hear what got you interested in digital assets and blockchain and stable coins too. But go ahead, Ken. You can do an introduction. I'll come back and ask that question.
Sure, thank you. After serving in the military, I have over 20 years of capital markets experience. I've worked on the buy side, I've worked on the sell side, and I've worked for firms like JP Morgan Investment Management, Bank of America Securities, Bridgewater Associates, which is the world's largest hedge fund, and BNY Mellon. I transitioned full-time from traditional finance to DeFi in 2018. And I had quite a few coworkers, friends, try to convince me not to do that. They basically, if you're having a midlife crisis, do something else. Buy a sports car, go on a trip, do something. Just don't go into crypto. But I did it anyway, and I got started my own company, T10 Ventures, which I use for consulting, advising, and also some investment. I advised a company, Crypto Fuse, in 2018. I helped the company launch at the London Blockchain Expo, and we were going to float an ICO in the fall of that year. And if anybody remembered, but during that summer, that's when the SEC came out for the first time and said, we're applying the Howey test, and we think most of what's happening out here is unregistered securities. So we kind of put a halt on it. We talked as a team, put a halt on it. I wanted to be able to continue to work in this industry, and I would look horrible in prison orange. So that's not something that I wanted to be a part of. So moved on from there, got involved with a few other companies, and then ended up going to Wells Fargo. And I never thought I would go back to a traditional firm, but I went back to Wells Fargo, but not in a traditional role. My mandate was to apply blockchain technology to capital markets, and really not much. That was my mandate. And so what that ended up being was around tokenization. Also, a small part of my mandate was also crypto. And in the summer of 2020, when Bitcoin really started taking off, I became the crypto guy at Wells Fargo. And I was looking at, all the different potential, business cases. What does customer demand look like? What we do to, service our customers in this area. And one of the things I was looking at was custody. And so looked out in the industry, looked at all the players in the industry, and I ended up choosing to work with Anchorage Digital. Anchorage Digital is the first and only nationally chartered crypto bank. It has a charter from the OCC. It's the same regulator that regulates the bank part of Wells Fargo. So that was really a kind of a no-brainer. And so I started working with Anchorage. I liked them, they liked me, and ended up transitioning over to Anchorage, where I was the head of banking and capital markets up until the end of 2022. From there, I went back to T10 Ventures. I've worked with a number of companies. I worked with a crypto custodian out of Europe, and I'm currently working with three very interesting companies. One is TCS, which is formerly known as Truck Coin Swap, and they're using blockchain technology, utility tokens to really just make significant, improvements to the factoring business in trucking and freight. And basically, the short of that is when a truck driver delivers a load, doesn't get paid for delivering that load on the spot. It's usually 90, 20, 100, 180 days. And so this company is really taking off. It's got great traction, got a great team. Another company that I'm working with is Link2. It acquires shares of pre-IPO equity, and very interesting companies. And the companies, for the most part, are unicorns, and they take that and make it affordable and accessible to all accredited investors. And the third company I'm working with is Indotech. It's a company out of Israel, and they led by Dr. Anna Becker. She's world-renowned expert in AI and the application of AI to financial markets. And she has 40 quants, backing her up. And they have this really amazing algorithmic trading solution. It started initially with foreign exchange, and now it's for the last few years it's crypto. So that's what I'm doing these days, and have my fingers in a lot of different places, a lot of pies. But I'm having a blast, and there's just so much happening in the industry right now.
Ken, that was a great background and overview. You mentioned the Howey test for those that aren't familiar, although I'm sure everyone's heard of it because Gary Gensler's always talking about it. But what qualifies the criteria around the Howey test is money. If money is invested, so there must be a monetary investment involved in the transaction. Is there expectation of profits? That there's a common enterprise. So you think about something like Ethereum and the Ethereum Foundation. Is there a common enterprise? And does the success rely on the efforts of others? So those are kind of the four key pillars of the Howey test for those that might be interested. Ben, a little bit, if you can talk a little bit about what got you interested in digital assets, and you said you'd worked on the kind of first stable coin to kind of be traded, or first was it US-based stable coin?
Yeah, it was a hedge fund. Yep.
Hedge fund. Yep.
So it was a yield opportunity, which was really kind of what brought us to opening the fund. And there wasn't really a way to take advantage on an institutional level. The yields that were on decentralized finance. And so one of the issues that was going on is that that particular moment of time, the interest rates were near nothing, like longer term interest rates for, whether it was annuities or bonds were like, well, 1.25. I think I sold like $20 million worth of some type of interest bearing product at like 1.75% in a month. And at the same time, I had a decentralized finance account that would, had a sizable amount of personal cash, earning between like 70 and 120%. And so there's obviously significant risks that were involved in that type of trading, but we had lots of clients that were very interested in taking advantage of that market neutral trading, along with arbitrage trading and high frequency trading. And so really there was a lot of opportunity to take advantage of the low interest rate environment. How I got involved with cryptocurrencies in general, at around 2014, I was informed about really what was trading in terms of the volatility of Bitcoin through some computer programmers that were that owned it, that are now extremely wealthy. And in 2015, I really started to get more involved. Started making my first purchases. 2016, my wife's good friend growing up was one of the largest orders in the Ethereum ICO, and who's actually called Ethereum Jesus now on Twitter, and he's a billionaire. And so he actually kind of really explained to me the implementation of smart contracts and the use cases on the financial side. And meanwhile, I was working at a regional bank that was still operating its loan systems on like a DOS pre-Oregon Trail infrastructure. So there really was a lot of use cases that really there was an enormous amount of opportunity if the architecture was built, and seeing where everything was kind of going in terms of the payment systems, especially on the bank side, and the settlement periods of time for real-time payments really made me extremely interested in terms of the compliance reduction costs, the intraday yields that could be operated on. And so really just kind of being a student of the markets for as long as I've been alive, just kind of dove head first.
So question for both of you, as it relates to banks and our capital markets, and I can ask you this first, but what do you see as the most interesting development out there? I mean, obviously, Bitcoin aside, because it's that's trading back up at 70,000 some change. But as it relates to either kind of digital assets or tokenization or blockchain, Ken, what do you see as the most interesting development out there? And then Ben, I'll ask you the same.
Yeah, what I see is very interesting, and actually excited to see it happen is BlackRock tokenized a bond fund, and just like you have HODL in the for holding Bitcoin, they have BIDL is their fund, and a lot of people don't understand the implications of what they did, but they tokenized that fund, and they did it on the Ethereum public chain. So a lot of these tokenization initiatives you've seen previously were done either a very limited scope, or they were done within a private permissioned, ring-fenced, environment. So this is, they tokenized out on a public chain, and just here in the last 24 hours, it's been announced that Circle is providing support to be able to providing smart contract support, so the holders of that BIDL token can exchange that for USDC, and there is no 2-day settlement cycle. It's not. I mean, this happens in real time, and also because BIDL's out there and it's in it's on public chain. It's being used for collateral on exchanges. It's being used for collateral for margin trading. So to me, I'm actually surprised that it happened this year right now, because it is something, many of the larger institutions out there are really not comfortable with, public blockchains. and to see, and I know that, Larry Fink, is a big proponent of tokenization, but for him, for that company to do it on a public chain, to me, it's, a lot of people don't realize how big a deal it is, but it's a big deal. And it's also going to allow others to get more comfortable doing this, which, that's the big thing for, for me, for, what's happened here in the past couple months.
Yeah, it's for those that aren't familiar, I'm sure everyone's heard of Blackrock, but they are the largest investment manager in the world with, I think, $10 trillion of assets under management. So that it is a really big deal. I'd be curious what either of you might think about. So I think there was a Senate hearing fairly recently, and Elizabeth Warren, who we know is no fan of crypto, but I think she was making the suggestion, and it was an interesting one because I've talked about this before, and one of the things that I've always thought could be a holdup for financial institutions using public blockchains as opposed to private ones is that you don't really know who are running the validator nodes in the case of like proof of stake or something like that. And you in theory, one of those validator nodes could be run by a sanctioned country or prohibitive individuals, and that might be an issue. And I've never heard anyone mention it up until the Senate hearing where Elizabeth Warren said, and Iran is making millions of dollars a month on potentially running validators. Now, she didn't offer any proof for that, but in theory that could happen. I'm curious what your thoughts are around that. And with BlackRock tokenizing those bonds and putting them out on a public blockchain, they've got to have done their homework on this, and so I assume they see it as a limited risk or one worth taking. What's your thoughts on that?
Well, BlackRock is an asset manager. It's not a bank in the terms of like you think of Bank of America, Citi, Wells Fargo, which have different regulators, different regulatory requirements. And so for those banks, that you talked about, like who's validating the node, or who's doing the mining on Bitcoin, who's actually doing that, is a question, and also a question that had come up when I previously worked at a bank was around finality. How do you know that this transaction is completely confirmed? How many blocks have to be added to a blockchain? And then you start getting into things that really nobody thinks about, where you could have part of the network that's cut off from the rest of the network. And the way Bitcoin, for example, works, it'll continue working. It'll be working in two completely separate networks. When those networks are able to talk to each other again, there's a whole process around how they determine who the winner is. And so that works great for Bitcoin, but not so great when you're talking about the financial system. And so I think that you're, at least for the time being, the larger financial institutions, particularly the ones you think of as a bank, I think they're going to stick more toward a permissioned blockchain. More likely they'll ring fence it among themselves. But as far as like going out and doing what BlackRock did, I think you'll see other asset managers do that. But really, I don't think you're going to see the banks doing that anytime soon.
Yeah, I mean, I think certainly from a know your customer BSA standpoint, there would be concerns with a public blockchain. I guess my thought is if you built the public and private blockchains using similar sort of technology, right, basically kind of on an Ethereum type of network, then you could, I think you could do kind of a cross-chain transaction to kind of connect those two. If ultimately we find a way to provide maybe a digital identity to people so we know who they are, to be able to do that kind of semi-anonymously. Ben, what's your thoughts on?
Well, I mean, there's a lot of advancements that are happening too with the real world assets being tokenized, with the clawback features being built on, and that's based off of the advancement of the ERC contracts. And so, meaning like instead of there's different features that are being built on the chain itself by the type of token that's being created, where you can claw it back, you can put a freeze on it, you can have only being allowed to interact with certain types of contract addresses or certain individual wallets, right? And so there are lots of ways to move around. And, Ethereum was created for the purpose that every individual has a right to access to the financial markets. And, that system as a whole, that quote unquote decentralized system, was designed to allow every individual. And then that's really what it may not be the perfect fit for banks, but asset managers have a lot more control in terms of the types of tokenized asset that is on chain itself. That being said, there are a plethora of options where you can use the infrastructure that Ethereum has built and operate a very significant and safe system, at least in terms of a walled garden, as Ken has been kind of talking about, where you can choose who you're allowed to play ball with. You can choose how the transactions are confirmed, and but you can still have the developer ecosystem that Ethereum has.
So maybe this is a question for Ken. With BlackRock's tokenization fund, I would assume that's got to be for qualified investors. So it's not like that's adding a lot of additional liquidity opportunities, because the people who are investing in that have plenty of liquidity, I would assume. There's probably more from an efficiency standpoint and from a speeding up settlement, like you had mentioned. Is that reasonably accurate, or because I always think about, like, why would a financial institution or why would a trading company use the blockchain? Well, it certainly can speed things up. Settlement can get nearly instantaneous. It eliminates things like settlement risk. You could tokenize other assets and improve liquidity, and more people could get into some of these funds at a lower price point than might be offered today. What's your thoughts on that?
Well, like Ben mentioned, there's some confusion when we're talking about like public chains. Public chain, some people think that, well, that's just, if it's on the public chain, that it's kind of the Wild West and, it's a free for all. But, like in the case of, any company, BlackRock or any other company, tokenizing assets, they can put, rules around that. They can put rules as far as who is able to invest. And that's also ties into the KYC AML, because you have a list of people that are able to invest or hold that asset, and that you can make a determination if you have to have there's a requirement for accredited investors. There's also a way to handle that, to make sure that only accredited investors are, that are holding the asset. So all of these things can happen. The things that kind of scare off, like the banks, is just, not knowing who's in control of the network. Aside from the validators or the miners, could you have a bad actor, that could, somehow get over 51% of the compute power on Bitcoin and be able to, take it over, what's called a 51% attack. Or, there's other attacks out there that could potentially happen, where, the banks just wrapping their head around that risk, even though it's a very, very small, remote chance of happening, it's still there. And you still, they still have to be able to, account for that. And so, I guess long story short is, even on the public chain, the institutions, like BlackRock and others, have the control that they need to have, to satisfy regulators and also satisfy themselves. And so, and then, from an investor standpoint, I think what we're going to see is, you may be in a situation right now where it's, maybe it's just accredited investors. And what are accredited investors? Just, I'll give the definition just for the people on the call here. To be designated as an accredited investor, you have to make over $200,000 per year over a 2-year period, with the expectation of making at least that going forward. Or you have to have over $1 million in assets, not including your home. And so that's, a bar that takes quite a few of the, kind of mom and pop Main Street investors out. But I do, see that as this moves forward, some of these assets are going to drop down from being accredited investor only to be opened up to anybody, with the caveat that there's going to be a KYC AML, and you're going to have to provide that information. You're not going to be able to operate with assets that are issued by a grown up, traditional firm. and be anonymous. It's just, that's just not going to happen. It's exciting times right now, and I think we're going to see more excitement through the rest of this year.
So Ben, same question to you as I asked to Ken. Kind of what do you see is really exciting for you in this space?
Yeah, and I hopefully I won't talk too much about this because it starts to kind of, the impact is substantial. But the BIS and SWIFT doing cross-border payments in conjunction with commercial banks and central banks. And so when we start to kind of think about what's so special about it, and there was that great press release that the BIS did, and they did a nice job explaining where they were able to combine messaging along with settlement versus making those two separate entities, right? Or two separate jobs. And by doing that, that settlement goes from being multiple days, especially, cross-border payments, you've got time zones, you've got lots of different issues, to being instant. And when you're talking about the money supply's got a lot of different elements in there, but typically when the amount of money supply increases, like when at the point of the transaction is at the loan, and that settlement, right, it goes from being a multi-day settlement to being a near instant settlement, can in theory cause money supply to increase on the books because we're operating a fractional banking system. And so start thinking about that and like the dramatic impact that could have doing tokenized commercial deposits and tokenized currencies, right? And then you have the infrastructure along with smart contracts being built in there. There's an easy way to route the commercial deposits back to the central banks at a speed of which that is 400% great faster, or that's just an arbitrary percentage that I threw out there, but several times faster than what was in existence. And so like what controls the money supply right now? Well, there's the velocity at which you can do the transaction, and then there's interest rates. So if the velocity of the cash has increased, right, does that mean that we are now going into a much longer period of time where higher interest rates because the movement of cash is going around, the money supply is increased? Now, again, we don't know these answers yet. And the other thing that's even crazier too is you start thinking about, well, if the settlement is now faster, the compliance costs in theory will be cheaper because you're able to combine two acts into one. There's all these transactions that you couldn't do beforehand because it wasn't financially feasible. You're talking about cross-border payments that were like, $40 plus, and then a wire, around the same thing. How many microtransactions are going to now occur based on that? And are we going to start looking at yield as like, what's my yield per hour? Because the settlement is so fast versus what is my yield for the quarter? And all the transactions that never could have existed beforehand now can exist in this ecosystem. And so does the interest rate adjustments now not be as important as the amount of transactions per second that can get processed? And that's where, I think that might be above my pay grade in guessing where these things are going, but we kind of said before the call, we were tossing around some different topics we might talk about today. And Larry was great enough to provide a great little list of like cool things to look at that are going on right now. And if I saw that list, last year, 6 months ago, about that these things aren't, they're these projects that are being done by SWIFT and by BIS, they're not test runs. They're doing it. And so the plane has left. We are absolutely going this route. The central banking digital currencies are already being created. It might not saying that the United States is doing it, but tokenized commercial deposits are very important. And a very improved operating system that has needed to happen for a long, long time because SWIFT is quite old, but of course there's been, a lot of technological advancements in it. But the settlement period of time and what that's going to do to the money supply is really what kind of gets me excited about how this technology really is going to change.
And that settlement risk, well, we don't think much about it domestically because it's not that big of a deal. But when you get internationally, it can be a real problem. And in fact, I think that's the reason why the DCB was formed. One of the big kind of institutional organizations was formed after, in 1974, German regulators shut down a bank, Hallstatt, put it into liquidation, but some of the trades hadn't finalized, and they had some some of it was in US FX and some of it was German. And because of that settlement time, it caused all sorts of problems, and there was people who didn't get paid from a settlement standpoint. So that, it is a real deal, and I could see how it could increase the money supply. I mean, I put in the chat that list of kind of topics that we had talked about beforehand, just so people can see, this is just a sampling of probably 100 type of projects like this that are going on around the world. But the big one is, I'd encourage people to look at it. Project Agora, which is a BIS project to kind of combine cross-border payments, but also tokenized commercial bank money, and combine that with central bank money for settlement. So it doesn't interrupt the current way that banks work today, kind of a two-tiered banking system where you've got a central bank that settles on the back end, and then commercial banks that provide, loans and capital formation and stuff like that. It works in exactly that system, but it uses, instead of every commercial bank having its own, and potentially every central bank having its own ledger, which I think you're a commercial bank or a retail bank, your ledger is your core. You would share that technology. Now, it could be provided privately, or it also could be provided as a public good. But when you have that, then that instant settlement occurs. Then you can have, because it's on and it could be a permission blockchain, then you have programmability of money. You can do all sorts of things that you can't do today that's really going to be critical for the future world economy. There was a question, and I want to pause to let people ask questions, because there are not many opportunities. They've got two great luminaries like yourselves on the call. But Robert Goodyear had asked Ken and Ben, I'd love to hear you give a devil's advocate counterpoint assessment of the overhead of blockchain for all transactions. Where's the break point? Where's it not be all end all to replace traditional data infrastructure? And I suspect what he's talking about is like, there are different blockchains for different types of solutions, right? And some of them transact much faster, transactions per second, or TPS on some of them actually surpass what Visa and MasterCard can do, but some of them are quite slow. So it ultimately might be different blockchains and different technology for different solutions. But I'll let you guys answer that, since he didn't really ask me the question. He asked you guys a question.
I'll get started. I think there's two ways of looking at this. One is looking at the blockchain itself, the technology, and you're right. Some of the platforms out there, process a lot faster than others, and the blockchain of the future, the one that's used 10 years from now, might not even be in existence today. So this is also an evolution that we're going through here, just like we did with the internet. And the other thing, as far as this is also an evolution, and this is also why I highlighted what Blackrock is doing with their BIDL token, is in many cases around using blockchain for tokenization. You're having the assets, I'll use the example of repo. So and what a repo is, it's a repurchase agreement. It's basically an exchange of cash for some collateral, typically a treasury, and it's an overnight transaction. And so, previously, I worked on led an initiative for the tokenization of repo, but it was at a bank, and with the rate, what was allowed to happen was you could take the treasury and have it at a leading custodian in a tri-party account. Then you can have the cash and have that cash in an account and immobilize it where it can't be used for anything else. And then you're transacting, on chain with representations of both of those. But when you do it that way, you're not really getting away from all of the extra work that comes along, because you still have the asset being, being held in a tri-party account somewhere. You have, the money being, frozen, and you still have to, after you do the repo, you still have to reconcile all that. And so when you're able to get to the point where the asset on chain is the asset, and the cash on the cash, or the cash equivalent on chain is the cash, and you don't have this, settlement you have to do outside, that's when this all becomes really powerful. And that's where tokenization, all the promises of tokenization, from, reducing counterparty risk, increasing operational efficiency, being able to have better cash management, better management collateral, all of those promises happen when it's all on chain. And we're just not there. As an industry, we're not there. And that's why it's so exciting to see what Blackrock is doing, because that is, well, although it's not a perfect solution, it's definitely a big step in the right direction.
In regards to the question too, blockchain is an operating system. It's software, and you have to remind yourself that at the end of the day, it's an evolved version of what banks run on right now, software. And the idea is that there is a better type of programming that allows it to be smarter with smart contracts. And then the other portion of it is it allows you to have an interoperable ledger, right? So the idea with any financial institution that is looking at saying, well, what's the situation where blockchain doesn't solve all these problems? It's not that it's not necessarily going to solve all the problems. It's that you have to find, you have to work with an institution that helps you onboard into the blockchain ecosystem that prioritizes interoperability and manages the risk, and understanding what you need as a customer. So that being said, is that at the end of the day, the most important thing is the customer of any financial institution and knowing what your customer wants. And if you are not using technology that is designed to be cheaper, faster, and all these other, value adds, then you may lose your customer. So the banking system obviously works right now. There are inefficiencies all over the place, just like there is in any industry. But some of the institutions that value technology more are going to find an interoperable way that prioritizes the regulatory needs of the bank, and also passes on some of that savings, and also passes on some of the increased yields. So it's not that I don't want to say that there's a devil's advocate conversation or a way of looking at it where you're saying that, like, when's this not going to work? It's just more along the lines of, as an institution, you're going to have to choose which portions are very important to your customer, and then make sure that you provide those value add services that are presented with this technology. And it might not be every part. It could be as simple as cross-border payments. It could be as simple as real-time payments. It could be as simple as only using the data elements of the ledger, and combining the messaging and the settlements. I mean, there's a lot of different use cases that can be done with this. Not all of it has to be done at one. And as Ken said, the end-all be-all answer probably isn't in existence right now, because I'm going to assume that we're going to, as a society, we're going to live a lot longer than 10, 15, 20 years, let's hope. And so there's probably going to be a new operating system or a new blockchain or something like that that's going to be substantial. I mean, we've got quantum computers coming out in the next couple of years that's making data encryption useless. Not useless, but problems. And we've got artificial intelligence that is, and I would refer to Ken more on this than I, but that obviously could be more intelligent than us in certain aspects. And if artificial intelligence is going to be using a financial system, I'm sure it wants interoperability. And being able to tangibly, and I mean this, I don't mean tangibly in the fact of me holding it, but tangibly in the terms of digitally tangibly have access to the asset, and to be able to move that asset And again, back to kind of the money supply, the velocity, the transactions per second, the velocity of the movement of cash is super important. And I don't think we need to be artificial intelligence to know that if the money moving around a circle speeds up, it does well for all the institutions involved. So that being said, as if you're making choices, make sure that you always know your customer, not know your client, but know your customer, and make sure that you apply those strengths to what they want right now.
And I like to remind people that the current accounting system of which banks' cores and ledger systems are based on is double entry accounting that was invented almost 400 years ago. While we now have triple entry accounting, this is not the TED Talk to go into the details around triple entry accounting, but you think about debits and credits and the reconciliation that's required in that process, the lack of immutability and the fraud that can be introduced because people can change those ledger entries. Those are all solved with blockchain technology. And so, there is no doubt, at least in my mind, and for me, it started, I've been looking at this now for a while, and I've been following a lot of what the BIS does. And reason for that is they're the central bank of central banks, right? So they coordinate a lot of what central banks around the world do. And the BIS was, I think it was last year, maybe a year and a half ago, they came out with a blueprint for the future, I think what they called it, future monetary system. And if you read that, it was all about central bank digital currencies, tokenized deposits, potentially stable coins on a shared ledger. And I'm like, wow, that's interesting. And then, fast forward a couple of months, all the big banks were working on a project called the Regulated Liability Network, and then found out that they're doing that in the UK, and other countries around the world are looking at that. And now with this latest project from the BIS, it sounds like they're kind of moving into a trial stage of really running this on a shared ledger platform and building this out, which is going to be really, in a good way, disruptive to traditional finance, as well as for the intermediaries and some of the providers. Like you think about core software developers, core software providers, banks' cores are individual ledgers. They're islands of data. When suddenly you've got a shared ledger, you don't need that necessarily. You think about the third-party intermediaries, and Michael Platt mentioned, kind of eliminating the middleman, right? How you think about like cross-border transactions today and who's involved in that, whether it's a correspondent banking relationship or whether it's a MoneyGram or Western Union. Those middlemen take a lot of economic rent out of that process, and it's expensive for the customers. It's slow, it's error prone, and there's now better ways. Looks like Jeff had a question as well. Oh, Cobalt.
Yeah, I was just going to ask a quick question,
Robert.
Yeah, appreciate that, Larry. As I'm trying to think through this world, and thinking about what SWIFT is doing there with maybe a shared ledger type concept, but then you've got like Citi that has its own ledger for tokenized deposits. I think JP Morgan maybe even has their own ledger for, and I think they're built on, actually I'm pretty confident they're built on the Ethereum platform. It might be a privatized version of it, but so I'm kind of curious to get your thoughts on how that advancement might create interoperability between banks through that channel as opposed through like the SWIFT network. Maybe it's just different use cases with central banks versus interbank. Or do you guys have any thoughts around that? Or
yeah, I will let those guys answer. Certainly Chase, JP Morgan's kind of going their own direction with their platform, but the rest of the big American banks all worked on that regulated liability network. And I'll put it in the chat, the link for that. You can see who was involved in that first go around. It's most of the big U.S. banks and then some international ones as well. But Ben, you can add.
Yeah, there's obviously been experiments and proof of concepts with a lot of different startups, a lot of coordinating team efforts with multiple different institutions. And, where it starts getting tricky is obviously overseas with different jurisdictions. And so one of the great things so like Onyx Network was like pretty much a copy of Ethereum, but they kind of create their own private chain. And so there's different ways that you can cross communicate. And there are many companies that are coming out right now to help create that cross communication. So right now there's like what in decentralized finance, which was like kind of one of the, I wasn't the originators of it, but they use this thing called bridges, which were high risk. And there's a lot of different exploits, and that's where you hear those huge hacks come from, but allows you to move from one system to another. And in essence, all it does is it takes your token on one side and it puts it in a safe little vault that's not so safe. And then on the other end, it spits out and prints another token, and it uses a 1-for-1. And so that's what tokenization is. And so it allows that interoperability. Circle, or USDC, which the second largest stablecoin, uses a mint burn mechanism, which is great for going on new blockchains and interoperability. And so that's where if you want to go from one blockchain to another, you literally destroy one token, and then on the other end, you print or make a new token. And so a much safer model. And that's really what I see as the most way for doing interoperability. So the mint burn mechanism that's built in blockchain is a really useful tool for interoperability. And that's kind of like where that memo or the messaging and the settlement piece comes in the traditional banking world, where that mint burn mechanism is just the tech talk way of saying, message and or settlement. And so by having that built into the code itself allows interoperability to just be created, and then really just building a front end in essence to use it. So like you just build an interface that allows, once you onboard as a customer from one bank to another, it wouldn't be too difficult of a process using a mint burn mechanism.
Yeah, I don't have anything to add to that. I think Ben did a really good job of explaining that, and I agree.
Other questions from the group? For those that will watch this recording afterwards, I'd posted some links in the chat. Unfortunately, you won't be able to see those in the recording, but I referenced the Regulated Liability Network. That is at regulatedliabilitynetwork.org. Really great paper. I listed some of the participants in that project. If you go to the BIS and you look up Agora, and that's spelled AGORA, that there's a great YouTube video on it. The BIS explains what that is and what it isn't. I would encourage people to listen to the questions that were asked by the reporters and the answers that the BIS gave. Those questions obviously were well scripted and well answered, but they provide a lot of insight into where they're headed. I mentioned that Regulated Liability Network because the UK is also looking at that very closely as a possible solution for again, kind of the future of finance. But just want to make sure those that watch this afterwards have a chance to kind of look up some of those links.
Yeah, no, it's always fun what questions they didn't answer to. So,
well, Larry, thank you very much for having us and having this conversation. I've thoroughly enjoyed it, and if anyone's looking to catch up with me, after this call, you can find me on LinkedIn. Again, my name's Ken Chapman. You type it in, I'll be the first one that pops up.
And Ken, you're speaking at Money 2020 this year, right?
I spoke last year. It's not
Last year,
confirmed
okay.
right now, but I'm going to speak at Money 2020.
Cool.
But I am speaking at the Digital Asset Summit in California next month. It's being held in San Francisco.
Awesome. And Ben, where can people find you if they want to follow up with you on either your companies or your interest in background with digital assets and
of course.
DOT?
You can always find me on LinkedIn, Benjamin Duggan. I think I'm the only bald guy with a beard that's under Benjamin Duggan. I can also be reached out at ben@berkeleycap.com. And if very easy to get a hold of. So I'm always on LinkedIn and checking my messages. So, and Ken, I might see you at the Digital Asset Summit in California. So I'm trying to work it out where I can get up there, but got family in town during that period of time. So I'm trying to, hopefully I'll grab you lunch.
Well, that sounds great.
Well, I want to thank both of you. This was really insightful. We went down a couple of great rabbit holes around, tokenized deposits. We talked about the Blackrock fund. Really great conversation. Appreciate your time today and your insights. And we'll get this recording out for folks to be able to view here shortly. And appreciate for those that joined us today live. And with that, everyone have a great day, and we'll catch up soon. Take care.
Thank you guys. All right.